Opinion, Sakti Siva of Credit Suisse continues to remain underweight on India. So what makes her so bearish? CNBC TV 18's Nimesh Shah caught up with her on the sidelines of their 19th annual Asia Investment Conference to find out the rationale. Listen in.
We are still underweight India. In fact, it's our second biggest underweight after Australia.
Okay.
I guess we have two main concerns on India. One is valuations.
Sure.
So if you remember, we have this valuation model, and every time the premium for India has gone to about 50%,
yeah.
which was actually in July last year.
Yes.
And when it got to 50% in 2006, 2007, January of last year, and again in July of last year,
Yes.
India has historically underperformed the region. So our first concern is valuations, that maybe a lot of good news is already priced in.
Sure.
The second thing that we are concerned about is actually the slide in India's ROE.
Okay.
So this is something we wrote about last week, that if you talk to investors...
Half, I guess you've written from 2007.
Yes, in fact, it's half the peak levels. When I talk to investors, including at our AIC,
Sure.
and you tell them China's ROE is slowing, most investors are well aware.
Sure.
But if you tell investors that India's ROE has slowed to the same degree,
Sure.
investors are surprised. So I guess there's two things. So it's not just valuations. We also highlight that India's ROE is now down to about 12%,
Sure.
which is actually half the high previously.
So, what do your quant model suggest? Like, I know you're underweight India, but in an environment where, the premium reaches 50%, the ROE slips, how much underperformance or how much, markets go down, in that period?
Because mine is more of a relative call, not
Sure.
an absolute call, because we are actually hoping for markets to be going higher. So our target for MSCI Asia Japan is 10% upside from here.
Sure.
But historically, when India's premium gets to 50%, the underperformance is about 10%.
Okay. So we can
over
go
the
back
next
to
3
the
months.
recent, the previous lows of 1600 odd levels.
We could, yes. I mean, but the thing is, if Asia is up 10, if you underperform by 10, you could also be flat.
Right.
So that's what I'm trying to say. I'm not saying that you have to fall.
Sure.
My call is more that India, in my view, is more likely to still underperform.
Sure. Shakti, you track the flows very, very closely. There has been a bit of an, inflows across EM equities. India saw a decent amount of inflows last month. What's that suggesting you? Is that long-only funds or the tactical money is moving back into emerging markets and to India as well?
Yes. One of the things that we look at a lot to see whether markets have bottomed is a factor called foreign investor capitulation.
Yeah.
And our definition of capitulation is very stringent. So foreigners, to have capitulation is not just 1 or 2 months of selling. It's rolling 12 months of foreign selling. So we actually got capitulation, I think it was the second week of January.
Yeah.
And we felt that once you got capitulation, then the low is not that far off. So in the month of March, as you correctly point out, there was 12 billion of foreign money into emerging Asia, and of which India got a good chunk as well. But because it is the first month after almost 10 months of selling, our view is that there is still likely to be foreign buying. In fact, on a rolling 12 months basis, the number we look at is still minus 0.4%. So we are still officially in capitulation phase. Yeah.
Right. So how are you tactically positioned India now? I know at one point in time you had Tata Motors in your core portfolio. You've dropped that. How are you tactically positioned now in India?
Okay, we have long liked Indian IT.
Indian IT, yes.
So I think we've liked it for 3-4 years.
Sure.
I think the analyst also likes it, so it's quite nice to be consistent.
Yes.
Partly because I have always had a constructive view on the US economy. I think in a bad patch, the US, in our view, is still growing at 1.5% to 2%. So that's driven that. But the stock that we recently added at the start of December was actually Hindalco.
Okay.
So why
metal stock?
Metal stock, yes. Why a material stock? Our view is, if you look at history, when the Fed tightens, every single tightening has been associated with the dollar peaking.
Sure.
So whether you looked at the 94 tightening, the 2004 tightening, or the 2013 Fed taper. So even though most investors were bullish the dollar and long the dollar, we actually started to take the view that maybe the dollar could weaken. And if the dollar weakens, it takes the downward pressure of commodity prices. And at the same time, Glencore was cutting output in aluminium and zinc. So hence the choice of Hindalco, yes. And obviously valuations were very cheap as well.
All right, that was Sakti Siva with a rather interesting perspective on the Indian markets as well as a few individual stocks as well. We're stepping on a short